Good afternoon and welcome to another Monday Mortgage Moment. I don't know if you've ever noticed, but the banks tend to have seasons where they have campaigns and they have a particular product focus. This time of year, now it is a little bit later than normal, but the spring real estate market is usually when you see those huge discounts on mortgage rates, right? So the really low rates, because the banks are basically competing against each other and competing against other lenders to get as much mortgage business as they can at this particular point in time. Where I want to give you a caution on that is sometimes when you're looking at these low rates, there's things in the background that you don't necessarily see or that aren't explained to you that can really cause you headaches and increased costs down the road. So when you're looking at the really low rates offered by the banks, so right now, I mean, some banks are even offering less than 2% on a 5-year mortgage. Have you ever noticed that banks have posted rates and they have discount rates? So throw some statistics at you. I would say 80% of the Canadian home owners population usually get a 5-year mortgage. 65% of those people in a 5-year mortgage will break that mortgage between year 3 and 4, right? Whether it's because you're moving, you've lost a job, you've had a baby, you're getting married, you need to upsize, downsize. There are so many reasons why that perfect home today might not be so suitable in 3 years' time. When you have a mortgage with a financial institution that has posted rates, and those posted rates are usually at least 2% higher than what your discount rate is. So you could have a posted rate of 4.5, but you're actually paying 2.5, right? Where that posted rate comes into play is when you go to break that mortgage. One of the ways they calculate the penalty is something called an interest rate differential. So the interest rate differential is the difference in the interest rate that you're contractually obligated to pay, and that is the posted rate, not your discounted rate, and the actual rate that the bank is now lending to clients 3 years down the road when you're breaking your mortgage, right? So the difference can be quite significant, especially if rates have gone down in the meantime. With some lenders, they don't calculate the interest rate differential on a posted rate. They actually calculate it on your actual discount rate, right? So when you're calculating an interest rate differential, you could be looking at a $3,000 penalty with one lender versus a $12,000 penalty with another, just because of the difference of one using a posted rate versus one using the actual discount rate. Now, where you also want to be careful is if you're dealing with what we in the industry call a B lender or an alternative lender. Sometimes these lenders offer ultra low rates as well. One of the things that is sometimes attached to those low rates or no frills mortgages is they actually have a clause in their mortgage document called a bona fide sales clause. What that means is that you cannot break your mortgage unless you sell your house. And that can come as quite a shock to people sometimes if they've taken a longer term and then life happens and for some reason you need to break your mortgage, only to find out, oops, sorry, you can't do that. So again, I just want to caution, where some of those rates look really fantastic right now, make sure you understand all of the fine print behind that rate and how it could potentially impact you going down the road. Hope you're enjoying your day and staying safe. My name is Brenda Sainamond. I am a licensed mortgage agent with Mortgage Sense in Barrie, Ontario, and I thank you for tuning in.